TV18.
A weak global sentiment following the U.S. Fed Reserve's rate hikes roiled global markets this week and led to a sell-off on the Wall Street as well. The Sensex and the Nifty lost 2% on Friday and turned negative for 2022. Hello and welcome to the Editors Roundtable. We take stock of the week's market action and, of course, put the spotlight on several sectors. This week, it's on cement and IT. I'm Sonia, and with me today, there's a full house. All the editors in the room. Welcome back, folks. It was indeed a week where topsy-turvy, but by the end of the week, you'll have to say that all markets were down, including us.
Yeah, down but green, Sonia.
Sonia is in green.
Always, right?
That's a support. So that's much needed now.
Yeah, but you know, this week was very interesting because I think the market got a bit tired of hearing this decoupling. So the market said, let me show you recoupling. And I think that's what happened on Friday. And I think the brutal nature in which the market fell, I don't know if it was just cleaning out the excesses. Yesterday, I felt the market was cleaning out the excesses. And yesterday was expiry as well. Today, being the first day of weekly series, I know the expiry happens on Thursday. The way the market collapsed, led by the banks, led by the large stocks, my fear is that, you know, the ETF money which drove the market higher, is it on its way out? I think because that money doesn't care whether you're India or China, it only wants momentum, and the momentum clearly is missing. That's my sense, you know.
Absolutely. I think also it's it was just a matter of time, right, before our market sort of gave way, considering that so many rate hikes across the world, and there's an RBI policy next week as well.
The point is, the world is slowing, right? Rates are going up, world is slowing, dollar is going up. Thankfully for India so far, I mean, oil is well behaved. Yeah. So, and I think oil staying at 90 is imperative. So, as Anuj said, it's possible that decoupling becomes recoupling, and I'll talk more about that a little later. Let's hope it's not too big a gap.
Remember, Rhythm said last week, right? There is nothing called decoupling. Maybe we'll couple less, will be less coupling, but there is nothing called decoupling in this world. So I guess finally now India is catching up to the global weakness, to the fact that for so long we've been ignoring the global data, right? Dollar index at 111, yields over 3.5, and we're just ignoring all the data and rallying every week. I think that's what the bit of reversal has happened. And also what Anuj said, you know, I guess the feedback what I'm getting is the most crowded trade of late was financials. Thanks. And that's what it's playing up on the downside as well. Look at the kind of fall we saw today. Bank Nifty was down 3%. So I guess that's also playing up in terms of the underperformance in financials.
No, I think that thesis about the Nifty Bank, that's going to be put to test, right? Because that became an overcrowded trade, and if you're going to get a couple of % cut even from here, if it's still good for more, then let's see whether or not you see money flowing back to that sector, because that's clearly been the big driver.
Okay, so are the bears saying abhi to party shuru hui hai? Is that what the angle that we're taking on the show today?
No, I think the market is still fine, Sonia. Okay. You know, look, I'll still give it benefit of doubt because the larger trend is still on the upside. Unless you start to capitulate completely below 17,000 and all, I think let's give the market. It's been a week, and after all this, how much will be down for the week?
Absolutely.
Not by a lot.
Yeah.
It's okay.
Okay, the sector to focus on this week clearly was IT, right? After Accenture's numbers. So you're going to tell us a little bit about that.
Yes, and you know what? I'll just go through the wall and explain it in numbers because IT was market's first love, and it's almost all of a sudden become its ex-girlfriend, right? Just look at some of the numbers. First of all, in terms of the flows, and this is something which I had pointed out 2 weeks back as well, that financial services are leading the inflow, $670 million, and FMCG, autos, capital goods. So that theory is intact that a lot of money is shifting from IT. Look at the outflow in IT. This is for the fortnight between September 1 to 15. IT saw outflow of $500 million, and $500 million going out, financial services gaining most of that, and FMCG, autos, and capital goods. But that is now well documented that this is happening. Now let's look at what's happening in the IT sector alone. It's seen negative flows in 11 out of last 12 months. That's the IT index, and it's down about 32% from its 52-week highs. But even after a 32% fall, it's up 46% over the last 2 years. Just to explain this first point more, let's have that graphic. There it is. Just look at this. Just one green bar. The rest is all red bar. This is all the FII data. This is NSDL data that we get, official data. So before that, you had seen this big buying. Now this is all red for IT index and IT stocks. Now let's go through some individual stocks just to highlight what exactly happened in some of these stocks. Let's start with the large caps. Infosys, after COVID, saw 230% rally. It's a large cap stock, giant cap stock. It's fallen 30%. TCS saw 140% rally. Of course, there was a big gap between Infosys and TCS. So TCS has fallen a bit less. Look at Wipro. That is where you had the multi-year breakout, remember? 300% rally in Wipro. It's become half of that now. Even then, it's up, right, over 2 years. HCL Tech, 250% rally. It's fallen about 35%. Tech Mahindra had 240% rally, and it's fallen 43%. I take Mindtree for mid-cap because that really was the sentiment barometer for the mid-cap market. 600% rally post-COVID, and you have seen the decline. Now, what were the key sectors which led to this rally? And I'll come to why the decline has happened. This was the only sector which had earnings visibility after COVID. Zero interest rate was the other factor which was driving valuation. So what happens is when interest rates come down, you tend to inflate companies which have higher earnings, and you keep giving higher multiples. 20% EPS growth, if only multiple goes up by 10 notches, drives stock price by 80%. Yes, that's what happened with some of these IT companies. And of course, the companies then started paying top dollar for the talent because, you know, there was quite a bit of demand and they wanted to pay as much as they could just to get talent. Now what happens? The U.S. Fed starts to hike rates, and that's when the valuation factor comes in. The U.S. companies started fearing recession, so obviously they start cutting down on their expenses. That means there's a margin pinch. And you saw what, you know, the companies losing tolerance, for example, Wipro coming down hard on moonlighting. And now there's fear that this quarter there would be top-line pressure as well. FedEx, for example, is going to cut down on its costs, right? So that is the big problem for the IT companies. Now, just look at the valuations. And this is the point I was making about 3 months back as well, that where do stocks need to go back to before the rally starts again. Infosys, pre-COVID, the price earnings was 18. It went up to 32. It's at 25 now. Now, I'm not saying it goes to 18, but it needs to correct to say around 20 or thereabout. TCS from 23 went up to 35. It's at 27. I think it needs to correct a bit more. Wipro has already corrected almost to pre-COVID levels. And I think HCL Tech is the other one where you have seen a valuation correction, compression. Tech Mahindra is the other one. Mindtree from 20 went up to 52. 52 times for a mid-cap IT company. And it's now down to 28. So I think these are a few companies where, perhaps you've seen maybe some value. One final chart, I'll leave it with, just look at this PE versus the stock price for Infosys. This is where when the gap became too big and you've seen the big correction. Remember this. This is when the valuation gap was this big. And when you get something like this, stocks rally big. But when you reach this kind of a stage, stocks fall big. That's the valuation metrics as far as Infosys is concerned, because that really is the barometer of the entire sector. So I think that's something which stood out for me. But Nimesh, what's the dealing room gupshup?
Anuj, I just want to put this week's fall into perspective. Look, we've rallied 3,000 points from the lows of 15,000, right? We were at 18,000, 18,100 something. What we are right now is around 17,300, 17,400. So hardly 700 points or 800 points fall. It's largely a catch-up on the global underperformance. We've been rallied so hard and we've been outperforming every week on week. I guess this is a week where we are doing a bit of catch-up with the global peers as well. The global data has turned a bit more negative. Even the fact that the India macro has turned a bit negative as well. So I guess that's what the bank Nifty fall today seemed to be. I guess that's the simple reason that we are doing a bit of catch-up in terms of the outperformance that we've been doing of late. The other important thing, I met a lot of corporates as well as the investors at the Moti conference, this week. It's turning out to be a consensus bet in terms of sectors. The first is financials, second is defense, and the third is manufacturing. It's becoming like a consensus view across investors, and that's what is reversing now. Look at financials, what happened. People are only talking about Bank Nifty today, but Thermax in today's trade was down 7%. We saw what happened to Schaeffler this week. We've seen so many of these capital goods falling. So that's basically a reversal of over positioning or over credit trade, so to speak, in some of the sectors which got reversed in this week. In terms of flows, again, the feedback is, yes, you may be right, Anuj, to some extent that there is a bit of ETF withdrawal, which is moving from India back to other countries. But I haven't heard any big panic selling, so to speak, from the larger institutions, whether it's FIs or the DIs. And lastly, which has been a consistent feedback for the last many weeks now, the supply of paper. Every week, you're getting at least 3 to 4 blocks where private equity investors, your promoters are selling out. So that's a bit of a warning sign, according to me, and that's going to be the case this week as well. We heard PI Industries selling a small block. So that's something which is going to be irritant for them in terms of flows. But I guess what happened this week is purely a reversal of massive India's outperformance to the global peers. And that's played out this week.
Okay.
Well,
I guess Nigel, you are going to talk about cement. I'd love to listen to what your take is on cement.
Nimesh, you make a lot of calls and you get most of the market gupshup. For the last weekend or so, people have been calling me up and telling me this deal is going to be announced, that deal is going to be announced in the cement space, and we have discussed this as well off the record. So let's run you through what exactly excited the cement space in this particular, past week or so. Well, what happened first? The new promoter of ACC Ambuja Cements, that's the Adani Group, they have announced they're going to be pumping in big money in Ambuja Cements. And because of that, in fact, the street got very, very excited. Remember, because of that big infusion, the promoter holding was likely to go from around 63% to around 70% post the conversion of warrants. The total quantum was nearly around 20,000 crores or thereabouts. The problem was, sometime during the week, they announced that they have pledged most of this holding, which soured sentiment a little bit. Now, Gautam Adani, he says that they are going to be the most efficient and the largest cement company here in India. That means they're going to be giving Ultratech Cement a run for their money. As per the current plan, ACC and Ambuja put together will be 80 million tons. So effectively, he's saying that they're going to be doubling their capacity out there. The street interpretation is clear. They believe there's going to be big inorganic growth out there. And they believe that some of these regional players, they offer strategic value, and that's why they could be part of this big consolidation theme. So let's run you through some of those stocks out there. From the south, we know India Cement, they have dominance out there. In fact, they have 84% of their capacity out there. Large asset, street believes maybe something could brew in the southern part of the country. And in fact, those are some of those companies up there with their capacities. Next up, Nobuco. That's been the hot topic out there. Big capacity, 25 million tons or so. Is it on the block? Well, we don't know, but the street believes that there is something going on out there. East Focus Company. Well, moving to the central part of the country, remember, ACC and Ambuja, they couldn't ramp up over the last few years. Another company has been Heidelberg Cement. So that one as well was buzzing in trade, and a couple of other names like Sankey as well as JK Lakshmi Cement. Finally, why inorganic growth? Well, replacement cost. That's the cost of setting up an asset is around $100, $110 per ton. Some of these companies, they are available at much less. So let's see whether or not any of these do get closed out. But the street believes there's going to be some inorganic growth. Back to you guys.
Okay, thanks a lot for that. So that's the cement space, right? Clearly the hot topic this week. But what do you watch out for next week? That is what we're going to tell you. The RBI policy comes up next week on the 30th of September, and a dipstick survey by CNBC-TV18 indicates that there's a 50 basis points rate hike coming, and the stance of the RBI could be cautious, especially after what the U.S. Fed came out with. In fact, Goldman Sachs just raised the RBI repo rate forecast to 50 basis points rate hike after the U.S. Fed meeting, and they expect a further rate hike of 50 basis points in 2023, which would take the repo rate to 6.75% by April of 2023. Now, remember, the rupee was also the big talking point last week, and the RBI intervened to at about 80.8 to the rupee, but the rupee fell to a record low. It had a lot of other global currencies for company as well. And in that context, a couple of things to remember. We are in a restrictive monetary policy tightening cycle globally, right? So not just the U.S. Fed, which raised rates. There was the Bank of England that hiked rates by 50 basis points. It was the 7th consecutive hike. There was the Swiss Central Bank that hiked rates by 75 basis points and now is out of negative territory. In that context, the U.S. GDP numbers also become important, the ones that come out next week. So lots to talk about. We'll do one thing. We'll take a quick commercial break. On the other side of the break, Pankaj Tibrewal of Kotak Mahindra Asset Management Company will be with us to discuss all of these cues. Don't go anywhere.